Uh, Good afternoon, everyone. This is the 10th of September 2016. It's been a pretty interesting 2 weeks, and there have been multiple signals to actually watch out. And I've been, in fact, wanting to make this video. I thought I would do it last week. I thought I would do it last week. There was a lot to say about the dollar, but then it's been in this range, giving mixed near-term signals. And now that I'm actually doing this video right after what has been a big overnight move in US equity and bond markets, it would appear to be timed to create a rhetoric around what might happen because of that. But probably these are developments that have been happening over time because in the long short report that I'm giving out to those signing up on the newsletter. Essentially, what I wrote in Feb was whether you'll get a small X wave or a big X wave, and a big X wave scenario would be one where you retrace maybe up to 61% of the entire decline, which was at 8250. So 8600, 8800, 8900 was not exactly what I had in my mind. But does that change the overall big perspective? The big picture does not change in my mind. It remains the same. But what has ended up happening is that it's become a bigger wave, and we are still in what would be the third wave of the mid cap rally, or be a complex correction in the main index, which has still not made a new all-time high, despite 5-6 months of rally where the broader market indices, all of them, including the BSE 500, has actually surpassed the March 2015 high. So that has made it interesting. And so the key highlights over the last couple of months were that a lot of positions, which is what I discussed in the August long short report. I haven't published one for this month yet. And in essence, what I focused on there was the big picture rather than the immediate move, because that was not playing out. And the big picture has only gotten bigger because positions, not just in our market, the daily positions which are published by the NSE of the FIs, and you should look at that as in similar context to what are the COT positions which are published in the US. So these are all commitment of trader positions, who's long, how much long, and how much short. And in our case, we have it in the Nifty futures and options market data available in the US. You have it across securities. And when you put all of that together, you have multi-year, multi-decade, or I should say in some cases, since the data became available, a new all-time high reading in positions for Dow Mini futures, for the US bond market, for the combined commodities positions, for our own FII to DII positions, which I wrote about, tweeted, and I think it was even published in the Economic Times about a month back, and even that high got surpassed because a month back it was still the second highest reading in August. And so I thought that you've been at that level twice before, and both times you at least got a consolidation or a correction before going higher, which means a 4 to 5% cut, or in March 2015 we got the final top at around 250,000, 60 to 50 to 55,000 contracts. And this time around, we were there all through August, and the market did not move. In fact, it did not correct more than 1.5% at a time, and then kept bouncing around in the same range. And the whole month was gone, and then next thing we knew, you're at 8,900. So what happened in that time is that these positions exploded to what is another record reading at almost 350,000 contracts now. So, and this has been happening across. It in fact happened even in the precious metals. Silver had its highest position readings since June and July, and it just stayed there even as the markets were heading higher. Now these readings can sometimes mean that it's sentiment that's gotten very positive, and while it can get unwound in the near term in terms of a correction, it might mean that there's enough support for another move up. So we leave that open to question, because different tops and bottoms have behaved differently. High readings have always led to a correction. Sometimes they have led to a major top. So you can argue both ways, whether this is only a sign of a near term unwinding or cooling off period, or whether it's a major reversal. But the way to do that is essentially combine it with the Elliott wave structure and momentum, and that's when you can take advanced signs of what is happening. That does not mean you cannot be wrong at times, and sometimes a couple of times in a row before what you expect plays out. But there are many times where what I expect plays out immediately, and does so for many months, maybe a year or two, and then suddenly things change, and you have to go through a little more pain than seeing things play out right away. A lot of divergences develop, but we haven't seen so many divergences like we saw in 2015. Multiple tops and weakness in stocks which were continuously falling below the 200 DMAs, and I put out a study on that at that point of time. So you continue to get new highs, and now the markets got even narrower, where the number of stocks participating or sectors participating in the up move are getting fewer and fewer, and it's mostly been the mid and small cap segments that have been on fire. The point here is that these extremes do exist, and my reading Elliott Levi's remains that it's an X-wave, so I haven't changed that. Even if I'm bullish near term, for a couple of hundred points, that doesn't really change my big picture perspective as yet. I still don't see enough reason to believe that even an impulse of this is a bull market. But it's been a strong, big rally, bigger than what I expected. And one of the key metrics that 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 actually kicked off the big sell-off that we saw overnight, and I thought it would be the dollar. If you asked me maybe a week back, I would have thought it's the dollar that's going to go up because it had completed what was a three-wave correction and started to move up. But something happened midweek. Mid of this week, the dollar again did not follow through on what looked like an impulse to me, and then it sold off. It's still not broken the low of that point, but the sell-off at one point looked like it could be an impulse on the way down. So it got confusing, and it is still within that range. So which means you can still argue both ways. But the daily and weekly momentum indicators in the dollar are still on the sell side. Though the long-term structure is still one of a consolidation, which is almost now a one-year-long consolidation between the 91, 92 lower end and 100 at the upper end. And you are at the lower end and the fag end of that consolidation, which could be essentially a triangle in formation. And whether you will touch the lower end of that triangle or truncate is the only question to be asked here. So midweek it looked like maybe it's not truncated. Early last week when I wanted to do the video, I thought I would say that it's truncated, and I even published that. So it remained a question, and the impact it had was directly on our own currency. So early in the week when we broke past the initial levels and started to stretch into a 5-wave advance across indices, which is Nifty, Bank Nifty, all of them started a third, so they would do a fourth and a fifth, and the fourth was done by Wednesday, so the fifth should have formed, but the fifth itself seems to have truncated somewhere, because most of these indices, especially Bank Nifty, closed down by on the last 2 days of the week, looking like a 5-wave advance is complete from the August low. And so what has ended up happening here is that the mixed signal from the currency and while the markets was trying to make this final stretch, were that the rupee actually broke. It has two HNS structures, one is the minor one and one is a slightly bigger neckline. It broke the first one, and having already broken the rising channel of the last 2 years, it started looking like this was a major reversal. But one level that it has held out has been the 40-week average, and that's held out for almost the entire 2-year period. So midweek we went all the way below that, went down to the lower Bollinger Band. It looked like, okay, this is finally cracking up and maybe the market can finally take off. But in the last 2 days, that did not happen, and finally the close is again above that K level. The RSI is still above the 45 mark, and so if I'm going to be publishing that post later on the currency section, that the chart essentially remains the same at the end of the week despite all the intra-week volatility, and that put me off. And I wrote about the alternates that well, if it breaks this level, then 65.20 would be key, or 65.30, and if that goes, then probably we're looking at another rupee or maybe 2 rupees, or God knows what we're looking at in terms of further strengthening if this whole thing turns. But it didn't. And when I was looking at various other foreign currency pairs, they were all showing that they had actually been strengthening, or rather the USD had been falling against most of the emerging market currency pairs for several months now. Even the INR fell much less, USD INR fell much less, and so their corrections were almost looking complete, though they were still not all able to take off together. And so it looked like the USD INR won't make that deeper leg down, but still intra-week it's given that fear, and again managed to hold the second and probably I should say final support. But again, if it breaks, then we'll have to consider alternates. But as of now, end of the week, despite all the volatility, we've continued to hold and maintain the bullish USD/INR perspective, which to some extent may make sense given that we have this big payout coming in over the next couple of months. But it almost looked like that had been managed, and a lot of these moves end up happening overnight, which is what I've been saying. Somehow I'm seeing increasingly overnight movements in the currency pair in the foreign markets rather than in our own uh, day trading, wherein USD/INR it's an Indian currency and the biggest moves should happen here itself. So that's one surprise element which I think authorities should really deeply look into. It wasn't there in the 2011, 12, 13 period also so much, even when it went to 69 from 56. Even in that move, it was most of the moves were domestic and happening here during the day. So that's something to really ponder. So at the end of the week, we have the dollar in the same position where it was maybe last week. The dollar index leaving open some short-term, potential for moving either way. So we'll have to just check what happens in the next couple of days. Though the biggest reason to expect the dollar move up to continue is bonds, the rising yields. But that can be tricky. It's not necessary that you have rising yields and a rising dollar, though that's what typically is expected. And I'll explain why. In fact, on Thursday night itself, the 30-year bond was the first one that broke its shelf support, which is the 3-4 week trading range in which most of the bond prices were stuck in. But the other ones had not. The 10-year and so on had not broken that range on Thursday night. So Friday morning, I published that post, so it was not visible on the website because it got marked as an uncategorized post, even though we put it out on email to the insiders, but that is subscribers, but it didn't show up, so it's there right now. That was just an error. And so the 30-year had already broken that low, and many times we've got these signals from bond prices, but it didn't really have an impact on equities. But this would now be a third wave, and so that highlight was important, because if a third wave started in the 30-year and it confirms on the 10-year, then what we would be looking at is a continuation of that move. And so that's what you got on Friday. You got a continuation of the 30-year bond selling off, pushing yields higher, and now you have the 10-year and various other time frames also breaking those key supports into third waves down. They're breaking some 6 to 12 month trend lines as well. So I think this move in bond yields, which started sometime in June, July, where you got the first round of the spike in yields, and then got mostly ignored, even though yields didn't go back down. That is, the bonds continue to just move sideways. And the third wave is usually when most of the damage happens. Even in 2013, when the taper tantrum occurred, it's the third wave that really caused the biggest damage to Indian bond and currency market. So this is why it's going to be an important watch. But I must also highlight is that when bond yields shot up in 2013, the dollar itself was in a consolidation or a trading range, which we mostly marked as wave 2. It was not really rallying away. And the important thing is when US equity and bond markets actually sell off, sometimes the dollar itself does not strengthen, but it weakens. And that's something I've shown and discussed in the intermarket analysis section many times. Even at the start of the 2008 bear market, in the initial 6 months, the dollar was actually falling. And the reason is completely the opposite of the same reason that you would have seen work in favor of the dollar and US equity markets and asset prices over the last 2 years, is that when the dollar was going up, money was getting allocated out of various emerging markets and other countries to the US, and which is why US equity prices were still going up even when Brazil, Russia, China, and others were facing so many headwinds because of the rising dollar itself. So it didn't become a global crash. It showed up in the world index or the ADR index, which I keep publishing. The US indices continued higher, and because India is more correlated to the US and not a commodity country, and because we addressed our debt-related, bond-related issue in 2013 with Rajan stepping in, that we were not affected by that particular dollar rally. But that's behind, that's yesterday's news. The one thing that did affect us in 2013, and which is again becoming a headwind with this current bond move, is when US bond yields entered their third wave and were spiking up in the taper tantrum. and if this is a third wave down as it looks like so far, then rising bond yields would be a headwind for us, and that does not necessarily mean that in the immediate term you will get a rising dollar, though it can mean you can get a rising USD INR, which is exactly what happened in 2013. So that's the key takeaway to understand, and which is why while we've seen precious metals sell off over the last 2 days, you really need to watch whether they hold their major swing lows, even though it's a deep retracement compared to the last 5-day rally. If they do turn up again and you see the dollar fall off, so give it a couple of days to see whether that's happening, because if the dollar has indeed bottomed and starts to rally, breaks out of the 1 week or 2 week range, then you can seriously consider that the move up has started. Otherwise, I think it would still mean that it would retest 91, 92 before starting its major advance, 200 and higher, which is likely to be the next major dollar move. So till that happens, if we do get a dollar decline, it would be more because of falling US bond prices and falling US equities, and essentially as money would be booking out and moving out of asset prices in the US in the short term because of that bond spike. And then people would ask that, does this bond spike mean that Yellen is going to raise rates? I have no idea. We are watching bond prices essentially to see what the bond market is indicating about rates, whether somebody is buying, selling, whether it's a trend. And these yields are anyway far away from where the Fed is, so there's always a gap. So one need not be indicative of the other. Just what they do tell us is they do give us a sense of direction, which has been there all along, because the Fed has not so far said that they're going to do QE as a lot of people are saying. Maybe it's an eventuality, but they're still saying that they're going to eventually raise rates first before they do anything else. And probably if there is another QE round down the line, it would only occur after you've actually had data that confirms to a recession, which is what they would wait for. So even though there's a slowdown in the US, we see, yes, things have slowed down, it's stable, and they want to still raise rates, maybe not now, later, whenever, they may do that. But irrespective of whether they're doing it now or later, as long as that's the directional cue that the bond markets are taking, and which is what, even if you see, look back, the taper tantrum was, they said tapering, it started 8 months later, and it was a slow unwinding process, and they still said we would keep interest rates down. So it was essentially trying to manage sentiment, and which eventually got managed, because the near-term panics eventually got absorbed and got turned around. So which is similar to what they might be trying to do here. But when we are trading and we are looking at the near-term moves, we are looking at higher bond yields, which have broken out over the weekend, and which might be a trend that will last for a while, maybe a week or two, and that can mean lower equity prices and the cut from this extreme excessive positioning which has happened not just in India but across the world. Equities, commodities, bonds, precious metals, all of them together simultaneously being as long as they have ever been in the history of the data, which is one really big extreme that we've never seen. Definitely needs to be cut back a bit, if not reversed entirely, at least a cut back. So that would be the starting point to look for. That can mean a 5-6% kind of correction at least, and that would give us clues about whether more is coming or not. But when you're in this kind of an extreme, while things are galloping up, if you're riding something, the key is essentially having that trailing number, having a point at which you would take the call that yes, these things are a little out of control, and you need to really book profits, take something off the table, manage risk, and step back and let things normalize, and look a little more not overextended. And you'll always find the counter argument to this, because people will say, well, everybody's bearish, and everybody's not participating in the market, so this data is not really telling us the truth. But the data is the data. These are actively reported positions on a day-to-day basis to the NSE, to the CBOE, and so all this, or the CFTC, right? That's the one that publishes the commitment of traders data, and so it reflects what's really going on back there. What has been the primary support essentially has been a lot of liquidity, not not just that coming from ETFs, but also the SIPs. And so when people say the public's not participating, and when we have the largest flow of consistent SIPs coming since a long time, that's become the new form of participation in the markets, rather than directly trading with brokers and opening accounts, which used to be the trend in 2007 2008. The trend now is more to participate through mutual funds, PMS schemes, and through more recently a lot of SIPs, which make people feel that they don't have to bother about the day-to-day movements in the market, and that's been the primary source of participation. The other debates that have gone on, and I think I'll be writing hopefully soon, or maybe do a video on a lot of data points that I'm collecting for another economic winter update, and essentially it covers sentiment around things like increasing number of delinquencies and reporting of bad loans in the US. There was in fact in June July, S&P started publishing this time around, probably wanting to be ahead of the curve, unlike 2008. They came out with reports showing that the credit cycle was essentially turning, and they were getting an increasing number of I should not say defaults, but essentially loans that were being reported as potentially turning bad. And they plotted this number, and they've actually forecast the number to shoot up, and a lot of data points apart from that, which are at levels which would have typically meant that you're already slowing down or entering a recession in the US. But none of that has really affected the markets so far, but data is already there. So the S&P actually came out with this, so I'll try and discuss that. And at the same time, you have something called valuations, which are another debate. And there was this interesting chart which floated around most of social media showing PE ratios, price to book value, return on capital, growth, and then trying to justify that these are reasons why the market is not overvalued and will continue to rise. The joke in all of this is that this is based on the idea that the earnings cycle will turn, something that was a forecast even a year or two ago, and it didn't happen. In fact, the earnings cycle turned down in 2013 itself, when interest rates were, when we were actually facing a crisis well before the election. And once the election actually took place and the market rallied beyond 6,300 to 7,000, you essentially ended up seeing weakening in the rate of growth of earnings was actually falling. And when you actually reached the peak, by that time you had already started flattening to reaching negative growth rates. So the negative growth rate is what we got starting 2015 all the way for 4 quarters, and then we got this one quarter, which is the last quarter, where you had a little positive growth, and everybody's taken that as a cue to say that the earnings cycle has bottomed. And this is very similar to saying, well, if you get one IIP number that's positive for a month, the IIP cycle has bottomed, or that you get a new orders jump for 2 months and the order cycle has bottomed, and then it all crashes off again in the next couple of months. And so this has happened again and again, and I don't know why people just force this upon themselves without really having a couple of quarters of data showing that yes, the turnaround is actually happening, rather than simply going out and calling it. So of course, if you plot it on a chart and you see, well, if the earnings growth rate at the bottom, it can only get better, and therefore even if valuations are high, they might still become cheap later because markets are not overextended or over leveraged, and that's something we'll not know because a lot of money is moved from one segment to the other, which is it's coming in through the mutual fund route. A lot of margin funding is not showing up. A lot of borrowing by the bigger players who are participating in the market is happening through banks, and their extent of exposure is not small. It is large, but only comes into highlight when markets actually start falling. Then you realize, oh, there's so much that all the corporates have done through pledging of their shares and so on. And when the markets go up, you typically don't worry about it. And so leveraged or not is a completely vague question. But if you really put it in highlight, Nifty futures open interest in terms of value, the highest which was reached in 2008 was not surpassed till last month. We finally surpassed that number in terms of crores. The value of futures open interest is now at an all-time record. And the combined future and option position also went to an all-time record in the last quarter. So this happened after such a long period of time. It didn't happen in 2015 at the 9100 top, but it has happened now because of the wildfire moves in mid and small caps that everybody's come back and started even taking positions in the F&O market more aggressively, even though the share of the futures market still remains low compared to where it was in 2008, where it was almost 70-80% of the market. Now it's options which takes up almost 60 to 65% of the market. So that difference has not changed, but the total value of positions have definitely surpassed the 2008 high now in this quarter. So again, that argument is flawed, that there's no participation and there's no positions. They're all there. Then there's the valuation logic and turnaround logic, which could be true. There was in fact a Morgan Stanley report which got published and came off in the media. But the question is, did they really have growth coming in? Last year when they were hoping for a turnaround? The answer is no, it didn't happen. And the typical blame always in all of these arguments goes to, well, if the world markets do something, then we don't know. So you're expecting a turnaround in earnings. And what was interesting is this very report itself has said that India's exposure to the global market has increased because a lot of companies moved their business abroad. And in fact, the best performing sectors, textiles, IT, and so on of the last couple of years were essentially, and even auto ancillaries are all export oriented. So that was the big segment. And if we say that we don't know what is happening around the world and we're making a forecast on earnings when your global exposure to earnings has gone up, I think it's essentially misreporting or flawed research. I mean, you have research houses with hundreds of analysts. Some of these, Morgan Stanley is a global research house. And then if they say we cannot price this into our India earnings forecast, then that's really unusual. But they do say in this report that, well, they have added that caveat that they are basing it on all else remains stable. So that's the easy way to say that, things are going to get better, provided everything else remains stable, rather than say that we have a view on everything else, because everything else does not seem to be changing, though there's enough data in terms of rate of change terms showing a slowdown already taking place in the US economy, which has been the main driver of global growth so far. Of course, you would say China's been the major driver, but there's a slowdown in China data as well. And if you're watching as US as the main market, which is at an all-time high, it has been seeing slowing data for almost a year. So, and the reason it's at a high is people are reading that slowing data as a reason why the Fed will not be able to raise rates. So the arguments are completely turned on their head, and that doesn't mean that they cannot remain turned on their head forever. But to say that just because they are turned on their heads, everything is fine, would be misleading yourself, and therefore being prepared. Even if you're participating on the long side, if you say that no, the market's going up and I need to participate, you also need to have that plan, that level one number that would give you your warning to step back, step out, or move away from the markets. And if you're trading, then you need to always be able to book profits, trail your stopping points, and move out on a slightly tighter basis than you would as an investor. So those are things that you just can't stop doing. I don't think you're in the buy and hold from a 5-year, 10-year perspective till the economic cycle, what I've called the Indian economic winter as well, and various global headwinds have all passed a certain stage, which they still haven't done. And once they would have, then definitely I would call the next up move that develops from that point as the start of a new bull market. So still not calling it that. And the key thing is have those numbers in place, have your levels in mind, your warning levels at which you need to decide that it's time to step back or step out. That's all in this update. Thank you.